they're getting killed with taxes. They need more deductions through the business. They'd like to save more. All right, some are in a survival mode at this point. And will they have enough money to retire on? It used to be said that people need about 80% of their current income at retirement, and it came from three sources: Social Security, individual savings, and employer-sponsored plan. Well, now the question is, they still might need 80%, but they're living longer, saving less, and the retirement income gap is widening. We offer solutions through the feasibility study. Another concern of business owners, especially the professional doctors, lawyers, are my assets protected from creditors, judgments, and sudden death and disability? Those are concerns, and a retirement plan through ERISA and state spendthrift statutes are exempted from creditors and bankruptcy. Most of us know O.J. Simpson, right, Kevin? Well, he's receiving an NFL retirement plan, monthly, and nobody can touch it. Here's their objectives, which are really complementary and consistent with their concerns: reducing taxes, building a nest egg, protection from creditors, more benefits to themselves, and controlling employees' costs. That's what we try to do from a design standpoint as part of our feasibility study. And these are the 5 questions that will always come up in the first preliminary stage in the fact finder. How much does it cost to establish the plan? If I have an existing plan, and just a sidelight there, if you're not aware of Judy Diamond, that's a database that identifies all existing plans all existing employers that have pension plans, and I actually have that database. So if anybody's interested in getting, the existing plans in their area by zip code, we'll be happy to provide that as a service provided through Pravada. And I'm not going to go through all the questions, but these are the type of questions that I will address when we do a feasibility study, and we'll walk you through the process in a little bit of who does what, when it's done, and the end result. What I'd like to do now in about 10 minutes is just identify or illustrate some case studies, because I believe the best way to show you the opportunities is just walk you through some case studies. These are actual cases that I designed. My third-party administrator is doing the administration, and we've already set up the investments of the plan. So these are existing plans. This first page just walks you through the different types of plans, from a 401k to a profit sharing to a money purchase, the maximum contribution levels, and the percentage of salary based on the maximum $245,000 salary. But you will notice, take a look at the last type of plan, a 412E3 split funded with life insurance and annuity at the maximum. This is the first year deduction of $367,844. Now, there is a commitment, and it does require cash flow, and there is a comfort zone. But if you had a client that all they were doing was a 401k or an IRA, simply because they didn't know there were other types of plans available, and they had cash flow, they had a tax problem, wouldn't they be interested in knowing that they could set up a defined benefit and contribute and deduct $357,000 a year, especially if they were the only employee? The key is making them aware of this opportunity by providing a feasibility study and making sure their CPAs are engaged in the process, because they are the gatekeeper. They're going to find the cash flow to fund this plan. So the first case study, I'd just like to quickly go through a 5-person corporation. The demographics, their age, and salaries were shown. And in this situation, this client had an SEP, a Simplified Employee Pension, and we went in through a CPA and said, let's show you different options, because this business owner had 3 objectives. They wanted to reduce taxes, they needed flexibility in making contributions each year, but they wanted at least 90% of the contribution, as most small business owners did. Their current SEP, based on the same demographics as shown, got the same contribution of $54,625, but the business owner only got 50% of the total. With this profit sharing plan, which is called a new comparability, you'll notice the business owner got $49,000 of the $54,625, or 90% of the total. This plan is set up by classes. It is IRS approved. It falls under 401A4, which has been around since 1990. The final regulations were published in 1993. And again, it does not work in all situations. That's why it's a function of age, of salary, and demographic factors. That's why we do a design. But if you do a one-page spreadsheet that says, here's your current plan, here's a proposed plan, here's the deductions, and here's how much of the pie the business owner gets, don't you think that puts the client in a position to make a prudent business decision? And it doesn't take an actuary to figure out which of these two plans the business owner would want. Would he want a plan that provided 50% of the contribution towards himself or 90% of the contribution? So in this situation, the client went with the 90%. We set up a profit sharing plan by class, and those classes are defined by occupation or titles. And we also added a 401k safe harbor to this plan. Now, down the road, he could have a defined benefit in addition to the profit sharing and the 401k to this because of tax law changes. The bottom line in this case study 1 is we were able to show the business owner and his tax advisor that the net cost of this plan was a negative. And this chart illustrates this. Let me just walk you through it real quickly. The business makes a contribution of $54,625. They're in a 40% tax bracket with federal, state, and city. So the tax savings is $21,000. So the net cost after tax savings is $32,775. So the business owner got $49,000 of the $54,000. That's a capital transfer. That's a benefit that the business is providing the business owner, and that business owner is the business. So taking into account the tax savings and the contribution the business owner got, it was actually costing the business owner $16,225 not to do this plan. Now that's a real cost. It's more than an opportunity cost, and by doing a study and engaging the CPA, you can show the business owner and the CPA the true net cost of this plan, or to say it a different way, the true net benefit of this plan to the business owner from a tax standpoint and a leveraging standpoint. And you'll note that we haven't even talked products at this point. At this point, we're talking plan design to make them aware of what options are available. Another case of ours that I thought might interest you is a husband and wife corporation. Happened to be an S corporation. They had no other employees. Their salaries were as shown, and they were doing an SEP or a profit sharing plan. First year contribution of $73,750. We went in through a feasibility study and said, did you know you could do a 401k plus a catch-up of $5,500 since they're over 50? In addition, you can add a profit sharing component to that plan and increase the total deductions from $73,000 to $109,000. But the CPA that was involved said, you know, this business has been around for over 20 years. They have cash flow, and they didn't know that they could have a defined benefit plan. So we showed them a defined benefit plan. Option 1 was their current plan. Option 2 was a profit sharing 401k. Option 3 was a defined benefit, first year deduction of $305,000 plus a 401k with the catch-up, and they could also do a 6% profit sharing plan. So all of a sudden we put them in a position to say, did you know that you could make a contribution in excess of $350,000 if you had the cash flow, if you were willing to commit to the defined benefit contribution, and where is your comfort zone? So we provided them options. And again, the whole key to our feasibility study is making business owners aware of the options and putting them in a position with their CPA and their advisor to make decisions. So again, just in summary, any type of tax entity can have a retirement plan. Corporations, partnerships, sole proprietors filing a net Schedule C. Some of you listening in are business owners, so the best prospect might be yourself, because you can set up these plans. If you're a sole proprietor, you get 100% of the deduction, 100% of the benefit, and you get what I call commissions. It's interesting, nonprofit organizations can also have these 501c3 organizations. Most of you, if you're in that market, know that they're eligible for a 403b, but nonprofit organizations can have profit sharing or defined benefit plans. So it's a very niche market. So if you're interested in knowing more about how to work the nonprofit market with these types of plans, I'd love to have an individual conference call with who, if you are interested in that. So one of the issues that come up, and we won't spend a great deal of time on this, but if you have clients that have employees, obviously we need to address those from a pension perspective. You can't just ignore employees. There are rules that the IRS has, and employees are classified by part-time, union, independent contractors, lease employees. There are vesting issues. There are deadlines or time frames that we have to use. But that's my role and my third-party administrator's role to make sure that these issues, are addressed and discussed with the lawyer and the CPA and the business client. My role is to make sure that the plan, once set up, is compliant. This is one of the reasons why that I won't work until I'm 70. This is my oldest grandson, and I actually have two of them now. So let's talk briefly about defined benefit plans, because I know that was a topic for this workshop. One of the types of defined benefit plans that a lot of people have heard about is what used to be called 412Is. It's now called 412E3s, and actually it was changed January 1st of 2008 as part of the Pension Protection Act of 2006. But what I want to concentrate on is the past, present, and future, and talk a little bit about what they are, where they work, why some of the 412I plans are considered listed transactions, and what we do and the service we offer in the 412I. And I will start by saying 412Is, or again 412E3s, all right, let's say what they're not. They are a defined benefit. They're not a profit sharing plan. You cannot put 100% towards life insurance in the plan. They're not a solution for everyone. That's why we do a feasibility study. And if you were to ask your CPA and attorney about a 412I or a 412E3 plan, most CPAs and attorneys would say they're listed transactions. You have to file an 8886 form, and that is not true. Right? The IRS came out with notices in 2004 that, if you're interested, I can share those with you. I'm actually an expert witness on some defective 412I cases right now. But 412E3 is a solution. It doesn't fit in all situations. It is a defined benefit plan. And just to make sure Kevin was still listening, this slide has two typos on it. The defined benefit monthly benefit at age 65 has now been increased to $16,250, and the maximum salary that can be used for compensation purposes has been increased to $245,000. One of the resources that, if you want to provide gifts or resources to your CPA, the IRS comes out with 415 COLA limit increases. I have those available. They're available on the IRS website. What you want to try to do is become a resource to your CPA by providing drip newsletters to them. And I have some third-party websites that I can make you available that are free, all right, so you can become a resource to your CPA and to your clients.